whereas that is also having the highest risk. So as I've told, investments are just nothing but like if there is a highest risk, then there is a highest return is also involved. Money market instruments are what? They are short-term debt instruments that are being introduced in the India, and this is highly liquid and it is having a maturity period of only up to 1 year. So primary market is what? Where an investor is going to purchase the shares or purchase the funds or purchase the portfolio for the first time. Hello students, I welcome you to the second session in investment management. So before we move on to the session, I'd like to give my brief introduction. I'm Vaishnavi, Faculty of Commerce from Vidhyaashram First Grade College, Temple of Excellence. So in today's session, we are going to look into the different topics in Unit 1. So we'll see with the agenda. So starting with, we are going to start with the attributes of investments. So attributes are just nothing but the features. So what are the features of the investments? Next, we are going to learn about what is investment decision making process. So how usually an individual or any kind of company, so how they are going to go for the investment decisions and what are the steps that they usually take before they are going to invest in any kind of a portfolio. Next, we are going to learn about what are the money market instruments. So money market instruments are one of the important marketing instruments in the financial sector. So that plays a very important role in the easy flow of money within the country. So we'll see what are the money market instruments. Then next you're going to learn about the capital market instruments. So these both are two most important instrument portfolios that we have in the financial sector that usually helps in the easy flow of money in case of a country. Next, we're going to learn about derivatives. So derivatives is one of the instrument in capital market. So we are going to learn what is derivatives and what are different kind of types of derivatives we have got. So all these are the important topics for your final examination as well. So we'll see in detail one by one. So starting with the attributes of investment. So as I've told, so investments that we have discussed in the previous session that so investment is just nothing but it's like a sacrifice in the current present time so that you can enjoy the benefit of the investments in the future period. So that is a basic meaning of an investment. So we have also learned about why it is important, and we have also learned about the different types of investments we have got in current financial market. So now we will try to understand what are the features of the investment market that we have got. So first is about risk and return. So for any kind of an investment, so there is a risk and return. Okay, so risk is just nothing but like you are going to invest in any portfolio. So any kind of risks like a decrease in the returns that you are going to get. So usually there is a telling that like if there is a higher risk, then you're going to get the higher returns. So you just like a kind of a prediction. So say for example, you're going to invest in stock market. So you're going to buy some shares of any ABC company, like we'll take the Tata companies. Okay, so if you're going to buy the stocks of Tata company, you need to have a clear picture about what is the actual performance of the Tata company shares or stocks in the previous month and what is currently how it is doing it. So you need to have a proper knowledge about it. So even though when you're having a proper knowledge about it, sometimes the share prices might increase or decrease based on the type of the situations that are happening in the country, economical situations, political situations, or any internal situations that will be happening inside the company, etc. So usually in case of investments, there will be a risk as well as returns are also is been involved in it. So if you are going to invest in the Tata companies for a month or for 2 months or 3 months, you're going to invest it. So, and if the performance has been very good for the current portfolio, that is the Tata company, so you're going to get the highest returns based on the stock market at how much you have invested on each share. Okay, so investments is all about taking the risk as well as also enjoying the highest benefit, that is returns on the portfolios that you have invested. Next is about liquidity. So liquidity is also one of the important feature of an investment, because as you know, liquidity is just nothing but changing the investments or changing the investment that you have made into a immediate cash. That is called liquidity. Like I have told in the previous example, you have invested in Tata company shares. So now you are seeing that there is a fluctuations in the prices. So now you have invested for like 50,000 rupees. So you might have going to look in for another week or 2 weeks, and you're going to observe what is the prices that have been fluctuating. Or you might just look for just 2 to 3 days, and you might also analyze what is the prices fluctuation in the current market. Now you have got a feeling that the prices might go down. So now what you're going to do it, so you're going to immediately sell the shares into the market, and you're going to immediately get the cash back in return. So investments are just nothing but they can be immediately encashed by selling them into the market. Next feature is time horizon. So time horizon is also one of the important feature of an investment, because investments are being encapsulated with the time. Okay, so you cannot just get an huge returns with a less time. All that can be only possible in case of the stock markets that you're going to invest. So like I have told in the previous example, you are investing 50,000 right now in share market, and after you have got a very good performance into the shares that you have invested, that is a portfolio that you have invested, so then immediately if you are selling it, so you might get a higher return with a less period of time. So whereas that is also having the highest risk. So as I've told, investments are just nothing but like, if there is a highest risk, then there is a highest return is also involved. But whereas in case of capital market like mutual funds or any fixed deposits or any derivatives that you are going to purchase, so these are all kind of a longer term. Okay, so any kind of an investments which will be always been encapsulated with the time. So that means it should be having a proper time frame to get a good returns on the investments. Next feature is diversification. So you will be having diversified kind of portfolios, diversified kind of options in investment. Okay, so as an investor, so there is no compulsory that you're going to invest in only one kind of an investment portfolio. That is, say for example, you have kind of enough money. So that means you have got 1 lakh rupees. So now you might divide the 1 lakh as 50 and 50, or you might also divide that as 25, 25, 25 or 25, depending upon your possibilities or depending upon your understanding. You might divide it and you might invest this amount in different portfolios. So 25 you might invest in FD, 25 you are going to invest in stock market. So and your next 25 you are going to invest in any derivative market, and remaining 25 you are going to invest in RD. So that means into your bank account. So depending upon your capabilities and depending upon your investing power, so you are going to divide the portfolios and divide the money and going to invest it. So investments is all about a diversification of different kind of options that are available in the market. Next is about inflation protection. This is one of the important feature of an investment. So inflation, as you know, that the increase in the changes of the prices for a period of time, that is called an inflation. So investments will help you always to tackle the inflation rates. So in future, if you are going to draw the amount, so right now you have invested some amount in the investment options like mutual funds or fixed deposits, or you have invested in any fixed assets like that. So now you're investing it, and later you're going to sell the assets and you're going to get the cash immediately, and that and you're going to have a kind of financial independence in your hands that will also protect you in the inflation time. So that is one of the important feature. Next, about tax efficiency. So as I've mentioned in the previous sessions also, it helps the investor to save from different kind of taxes. Okay, so usually a person who is taxable income, so he's going to pay some tax amount based on the income he's going to get. So if you are showing the investments like insurance or fixed deposits or any savings deposits account you have opened in any kind of a bank, so now by showing those documents to the income tax department, you can save yourself from paying the taxes. Next is about market volatility. So that means it is having the highest unpredictable nature in case of the investment. So like I have told, stock market is one of the highest unpredictable market in the current period, because based on the economical, based on the political, based on the internal factors, based on the environment in the current share market, so there will be a fluctuations in it. So mutual funds or any kind of the share market will be always having the volatility in nature. So investments are always will be having a fluctuating rates. Next feature is about investment goals. So it is having a goal oriented one. So any kind of an investment will be always a goal oriented. Okay, like say for example, you are going to invest some fixed deposit right now in bank for amounting rupees 2 lakh. Now what is your goal is about, after a fixed period of 3 to 4 years, you are going to get a return from the FD that what you have made in the bank. So now here what is your goal? So that amount you are investing so that you can reutilize it for your financial purposes, like for your child's education or for any purchasing of any fixed assets, etc. So always investments is only about the goal oriented. Next feature is psychological factors. That means it is always been invested upon the psychological factors of an investor. So they'll be always thinking about it, and even you're going to invest in the financially, again you're going to invest in case of the emotional factor as well. So this is one of the feature. Next is cost efficiency. So that means sometimes because of the transaction fees or because of the service fees, etc. So you are going to get the less returns based on the actual returns what you are going to get. So because of the investments, you are going to get the cost efficiency from whatever the returns that you are going to get from the investment options that you have made. So these are the important attributes or features of the investment. So next we'll move on to investment decision making process. So these are the 5 steps usually any investor is going to go through. So step 1 is setting of investment policy. Second step, analyzing and evaluation of investment vehicles. Third step, formation of diversified investment portfolio. Next is portfolio revision. Then last step is measurement and evaluation of portfolio performance. So we'll see one by one. So first is setting an investment policy. So that means first step is what you need to understand, what is your policy or what is your objective behind your investment. So why you are doing it. So like say for example, your father or your mother, they're going to invest some amount from the time that you have born. Why? Because after you have get an age of like 18 or 20 or 21, 22, so that amount can be withdrawn by you or by your parents, that can be utilized for your education, higher education purpose, or for any business purpose, or for marriage, etc. Okay, so here first step for selecting a investment policy is to have a proper objective behind what you are going to do when your investment policy has been matured. So that is the first step. So selecting an investment policy is the first and very important step in investment management. Investment policy includes the setting of investment objective that I have told. First step is what? To have a proper investment objective or a goal before you started to invest it. Next step is analyze and evaluation of investment vehicles. So next step is what? You need to analyze in what kind of investment options you are going to go for. So we have different kind of investment options that I have told. We have mutual funds, we have fixed deposits, we have insurance policies, we have recurring deposits, like that. Okay, so based on that, now you are going to select what is the investment policy or investment portfolio that you are going to invest in for. So when the investment policy is set up, the investor's objectives defined and the potential categories of financial assets for inclusion in the investment portfolio is identified, the available investment types can be analyzed. So after have set up all your different objectives, what you want to do, how much you want to invest, what the different investment objectives you have in your hand, the next step is what? To analyze what are the different options that we have got. Next step, that is technical analysis. So that means analyzing the different investment portfolios that we have got. That means, so say for example, you have decided to invest in mutual funds. So now in the mutual funds, you have to start with the 2 type of analysis, that is technical analysis and fundamental analysis. So technical analysis is all about like understanding about the current mutual fund market. So how it is running, what is the risk factor in the mutual fund, and what are the different types of mutual funds we have got. So who are the mutual fund investors, issuers that we have got. So all these are the technical analysis that we have got. So it involves the analysis of market prices in an attempt to predict the future price movements for the particular financial asset traded on the market. So that means you are going to check all the document details of what kind of investment policies that you have got. So mutual funds, if you're going to invest in, so you're going to check what is the performance of the particular policy or mutual fund portfolio for a period of time. So that is a technical analysis. Next is fundamental analysis. In this analysis, you're going to look on the historical prices based on the assumptions that these trends or patterns repeat themselves in the future. So based on that, you're going to look into the historical one. So based on that, you're going to select the portfolio. Then its simplest form of focus on the evaluation of the intrinsic value of the financial assets. So in the fundamental analysis, you are also again going to look into the internal values or internal factors that influences the mutual funds portfolio in a better portfolio. So you're going to look into the technical analysis as well as the fundamental analysis. So fundamental analysis is just of the basic analysis of about the company, when it has been started, what is the status of the company, what kind of company it is, or what kind of market it is. So all these comes under the fundamental analysis. Next is regarding the fourth step is portfolio revision. So now you have understood like which kind of mutual fund you are going to invest in. So now you have selected like SBI Contra Life. So like that you have understood. So now you have selected one kind of policy, that is SBI Contra Life. Next, what step is to revise the portfolio. So under this, so investment management process concerns the periodic revision of the 3 previous stages. So that means again you are going to look into the 3 previous stages that we have gone through. Again, whether your policy is been meeting your objectives, your investment goals or not. So what are the different kind of policies available in the SBI area or in the SBI bank. So like this, you are going to analyze different kind of portfolio options that you have got in SBI. So now next is, this is necessary because over time investors with long term investment horizon may change his or her investment objectives, and this in turn means that the currently held investors portfolio no longer be optimal and even contradict with the new settled investment objective. So you need to, why we need to go for the revision, because so sometimes the investment objective that you have meant for in the initial stages, that might changes in the future period. So your portfolio should be in such a way that should be meeting any kind of the investment goals that you're going to decide in the future as well. So this is the fourth step. Next, fifth step is about measurement and evaluation of portfolio performances. So in this last step, the investment management process involves determining periodically how the portfolio performed in terms of not only returns earned but also in the risk of the portfolio. So here in this last step, you are going to analyze the returns as well as the risk of the policies that you have selected. Okay, so this is about the 5 steps of the investment decision making process. So next we'll move on to the money market instruments. So we'll see what is the basic meaning of it. Money market instruments in India refer to short-term debt instruments that are highly liquid and have a maturity period of up to 1 year. So money market instruments are what? They are short-term debt instruments that are being introduced in the India, and this is highly liquid and it is having a maturity period of only up to 1 year. Okay, so those will be called as the money market instruments. These market instruments are being issued by government, financial institutions and corporations to meet their short-term financial needs. So they are being issued by the financial institutions like banks or any financial institutions like companies, like loan companies. So like this, they are going to invite in the public so that they can fulfill their short-term objective. The money market plays a crucial role in the overall financial system by facilitating the smooth flow of funds between the borrowers and lenders for short duration. So this is only for the short duration, but only for the fulfillment of any kind of short-term goals or short-term financial needs for any kind of company. So this is the basic meaning of money market instrument. So we'll see what are the different types of money market instruments we have got. First is government securities. The name itself, we can tell that it has been issued by the government, that has been RBI. It is going to issue to the public for a lesser period of time and it can fulfill the short-term goals. So government securities, like we have got government bonds, government stocks or government shares, all these comes under the government securities. Next is money market at call and short notice. So money market at call is just nothing but it has been called by the companies for a different call period. So that you might have know that, like, so if a company is going to call for the shares, so say for example it is going to call for shares of 1000 shares. So now it is going to call for each share at a fixed price. So that has been say for example it is going to call for each share price at rupees 10 rupees. Now here the 10 rupees has been divided into first call, second call, third call, like that. So this kind of division of in the share prices and calling in the market will be called as the call market. Then next is short notice. So short notice is just the name itself, you can tell that. So it is for the shorter period of time. So you are going to lend the money or you're going to give the money to the borrowers and they're going to give you back within a short notice of 14 days from the day that they have received the money. So that is called the short notice. Next is money market mutual funds. So money market mutual funds are for short-term investment opportunities that the investors is going to have within a less than 1 year period, and you can invest in this kind of money market mutual funds daily or monthly or 3 months, like that. So and you can withdraw the investment after the maturity period within 1 year. Next is treasury bills. So this is the one of the kind of famous or important kind of investment opportunity that you have got. Treasury bills is also kind of a bills that has been given by the RBI or any kind of banking institutions. So this kind of bills are only for a lesser period of time. So that is like it is for 96 to 364 days. So the contract between the borrower and the issuer is like a bill for a 96 to 364 days. So based on that, the company is going to, or the RBI or the bank persons, they are going to issue the bills to the persons who wants to invest it, and they can get back the money within the 96 to 364 days. Next is commercial papers. So commercial papers is also one of the kind of famous investment opportunities that many of the investors will be having. So this kind of commercial papers are just like a contract between the borrower and the lender, and this is also for a lesser period of time. So based on that, the banks can also avail the loan to the lender. Okay, so this is the commercial papers. Next is certificate of deposits. This is also one of the famous kind of investment opportunity that we have got. So say for example you have invested in FD, so you are going to get a certificate deposit that so and so amount has been deposited into the bank for a period of time. So whether it might be 1 year or 2 years or 3 years, based on that your investment period, so you're going to get the deposit certificate from the bank. Next is commercial bills. So it is same like a commercial papers. So it is about like a bill that you're going to raise to in case of an transaction that has been happened. Like say for example here what happens is person A and person B. Okay, so person A is going to sell some goods to person B. So with a debt option. Okay, so here person B is the person who is going to receive the goods and person A is going to sell the goods. So now here person A can raise a commercial bill in the name of person B, and within a period of time the person B is going to pay back to the person A. So based on this bills, so person A can go to the bank and submit the bill into the bank, and he can get the loan from the bank, and the person B is going to give the amount directly to the bank instead of to the person A. So this concept will be called as the commercial bills. Next is about repo and reverse repo. So repo and reverse repo is just kind of a transaction between the RBI and the bank. So now here what happens, usually the RBI lends loans to the banks, and sometimes if the banks are having the excess amount in their banking branches or in their banking head office, so even banks can also give the loans to the RBI. So if the bank is going to give the loan to the RBI, that is called repo rate, and if the RBI is going to give the loan to the bank, that is called reverse repo. So based on that, they are going to take the loans from the RBI as well as the banks, and for a lesser period of, and that is for a shorter period of time. Next is money market mutual funds. So money market mutual funds, as I have told, so it is a small term investments in the hands of the investor for a period of 1 year, and they can invest in those kind of mutual funds for a period of like 1 year or 2 years or annually or for 7 days or 6 months, like that. Next is about bankers acceptance. So bankers acceptance is also one of the kind of the investment opportunities that you have got. So it is kind of like similar to the commercial bills. So here also, if the person A and person B is going to have a transaction here, so here person A is going to raise the acceptance, is going to raise the letter based on the transaction that has happened, and the letter is going to submit it to the bank. So that is called banker's acceptance. So based on that, the acceptance letter, the bank is going to lend the money to the person A. So this kind of investment is called as the banker's acceptance. So these are the important types of money market instruments that we have got. Next is the capital market instruments. So capital market instruments, we'll see the meaning. So a capital market is a financial market in which long-term debt over equity backed securities are bought and sold, in contrast to the money market where short-term debt is bought and sold. So capital market is for a longer period of time. So for money market instruments is for the shorter period of time, whereas capital market instruments is for the longer period of time. So capital markets channels the wealth of the savers to those who can put into the long-term productivity use, such as companies or government making long-term investments. So these kind of opportunities will be having for the longer period of time, and they can also get the highest returns based on the investment period that they are going to look into. So we'll see with different types of capital market instruments that we have got. So first is about two types of we have got, that is primary market. So primary market is a part of the capital market that deals with the issuance and sale of securities to the investors directly by the issuer. So primary market is just a contract or a direct contract between the insurance persons, that is issuance persons, and the investor. So an investor buys the securities that were never traded before. So primary market creates long-term instruments through which the corporate entities raise funds from the capital market. So primary market is what, where an investor is going to purchase the shares or purchase the funds or purchase the portfolio for the first time. So that will be called as a primary market, whereas secondary market is also called the aftermarket, and follow-on public offering is the financial market in which previously issued financial instrument such as stocks and bonds are bought and sold. So here in a secondary market, so the investments options that you have got, that has been already been previously purchased by the investor, that has been sold, and again you are going to buy it for a second-hand market. So those will be called as the secondary market. For the different types of capital market we have got, first is equities. So you know that equities are like a capital funds that the company is going to get for. So there are again two types of equities we have got, equity share and preference shares. So equity shares are the owner shares where they are going to buy the shares for they are going to invest the shares in the company for a period of time, whereas preference shares are purely based on the investor shares. Okay. So next is debt securities. So debt securities are also one of the important type of the capital market. So wherein you are going to get the debt from the company or debt to the company for depending upon the different portfolios that you have got for a longer period of time. Next is derivatives. So derivatives, that I have told in the previous session, that derivatives are one of the important capital market instruments wherein it is going to derive the money based on the underlying assets that we have got. So we'll see the detailed explanation about the derivatives in the coming slides. Next is exchange trade funds. So exchange trade funds is like importing and exporting of the goods from one place to another place based on the commodities that we have got. That is called exchange trade funds. Next is foreign exchange instruments, that is investing in the money market. So investments in the dollars or pounds or yens based on that, and exchange of the money from one person to another person based on the interest rates that we have got. So that is called as the foreign exchange instrument. So these are the important financial market instruments that we have got. So next is derivatives. So derivatives are the financial contracts set between two or more parties that derive their value from an underlying asset or group of assets or benchmark. So as I have told, derivatives is all about as a contract between the two persons. Based on that, the persons they are going to derive the market based on the underlying assetting or group of assets or based on any kind of a benchmark that has been set up by the stock market. So a derivative can trade on exchange or over the counter prices for derivatives derived from the fluctuation in the underlying asset. So based on the predetermined prices that has been fixed by the stock market, they can trade based on that, or they can exchange in a agreed prices between the two parties. So generally stocks, bonds, currencies, commodities and interest rates are from the underlying assets. So usually in case of derivatives, we can invest in stocks, bonds, currencies and commodities. So we'll see what are the different types of derivatives we have got. First is forward contract. So forward contract, the name itself you can tell. So it is a contract between two parties coming together and agree to buy and sell an underlying asset set at a fixed date to agree on a future price. So that means like two parties are going to come together. They are going to fix the prices. Based on that, they are going to sell the goods to the particular person on a pre-agreed price in a future date. So that is called forward contract. So in a simple words, you can tell it is an agreement formed between both parties to sell their asset on an agreed future date. So that is called future contracts. Next is future contracts. So in case of future contracts, it is similar to the forward contract. So future contract means an agreement made by the two parties to buy or sell an underlying instrument at a fixed price on a future date. So this is also similar to the forward contract. So under that, so here two parties are going to come together and they are going to fix the prices and they are going to sell the product in a future coming date. So here in case of forward contract, the right to sell the product is being only in the hands of the seller but not the buyer. This is called a future contract. Next is options. So we'll see the meaning of the options. So options contract are the third party type of derivative contract in India. Options contracts are way different than the future and format contracts because these contracts do not require any compulsion to discharge the contract on a specific date. So option contracts, we have two different types of options, that is call option and put option. So under that, so call option is like you are going to, it is also same like a forward contract. So two people are going to come together and you are going to call the persons that you are going to buy the product. Okay, whereas in case of put option, so here in case of put option, the buyer is going to have the option whether to buy the product or not. Okay, so call option is about like here person A and he is going to call for selling of the product in the market with a fixed prices or agreed prices based on the stock market predetermined prices. Now, whereas in case of put option, the seller B or any other person is having the right to obligation that they can buy the product or they can reject the product based on the options that they have got. So that is called call option and put option. Next is swaps contract. Swap contract means the agreement is done privately between both the parties. These parties who enter into the swap contracts agree to exchange their cash flow in future as per the predetermined formula. So based on that, they are going to sell the products based on the predetermined prices that have already been fixed between the two persons. So here there is no options between the buyer and the seller. Okay, so compulsorily here person A needs to sell the underlying asset to the person B. So based on the agreement that they have come for. This is called swap contracts. So these are the important types of derivatives that we have got. In the coming session, we are going to learn about what is fundamental analysis and what are the valuation of securities that we have got. So these are the important next unit topics that we need to analyze in the coming sessions. So I hope you have understood the different types of derivatives that we have got and different kind of investments that you have got, features of the investments, so decision making process and everything. So these are the important topics for your final examination as well. So I request you to have a proper revision before you start to study all these topics, because they place a higher weightage into the final examination as well. So I'll meet you in the next session. Thank you so much.